Welcome to the podcast. I'm David, and today we're diving into something that could, literally save you thousands of dollars in retirement. And I'm really not exaggerating here because we're talking about being a tax-savvy retiree in 2025. Now, I know what you're thinking. I agree. Taxes, really, it sounds about as exciting as watching paint dry. And by the way, I agree with you. But stick with me here because what I'm about to share could be the difference between, a comfortable retirement and a wealthy one. The truth is, retirement planning isn't just about saving enough money. It's about keeping as much of that money as possible when Uncle Sam comes knocking. And in 2025, we're sitting at a unique crossroads that presents both incredible opportunities and some serious challenges. Let me start with the big picture. The year 2025 is what I like to call a transition year in tax policy. Remember the Tax Cuts and Jobs Act from 2017? Well, several of those juicy provisions are set to expire at the end of 2025 unless Congress decides to renew them. Well, right now you're enjoying some of the lowest marginal tax rates we've seen in decades. Those 12% and 22% brackets. Yeah, they're your friends, but come 2026, they could jump to 15% and 25%. That means if you're planning a big withdrawal or conversion next year, you could end up paying significantly more in taxes on the exact same amount of money. And here's another gift that might disappear, the high standard deduction. In 2025, couples over 65 get a standard deduction of over $30,000, and singles over 65 get more than $15,000. That's a massive buffer that lets you withdraw substantial amounts from tax-deferred accounts before you even start climbing into higher tax brackets. But it's not just federal taxes we need to think about. States are playing their own games too. Colorado and Nebraska recently decided to be more retirement-friendly and reduced taxes on Social Security and retirement income. Meanwhile, California and New York are still taking their full bite. If you're thinking about relocating in retirement, this could be huge for your bottom line. So then what are some options here? Well, one is a Roth conversion. If you haven't heard of these, you're missing out on one of the most powerful tools in retirement planning. Here's how it works. You take money from a traditional IRA or 401k and move it to a Roth IRA. Yes, you'll pay income tax on that converted amount this year. But here's the magic. Once it's in the Roth, it grows tax-free forever. No taxes on growth, no required minimum distributions during your lifetime, and your heirs get to inherit it tax-free. Why am I so excited about doing this in 2025? Because we're potentially looking at our last chance to convert at these lower tax rates. Think about it. If you're in the 12% bracket this year and convert $20,000, you pay $2,400 in taxes. But if rates jump to 15% next year, that same conversion costs you $3,000. That's $600 more for the exact same benefit. My favorite strategy here is what I call bracket filling. Let's say you're a married couple with $60,000 in taxable income, putting you comfortably in the 12% bracket. You could convert about $20,000 from your traditional IRA to a Roth and still stay under the 22% threshold. You're essentially buying future tax-free income at today's discount rates. But here's where timing gets really smart. The sweet spot for conversions is between when you retire and when you turn 73. That's when required minimum distributions kick in. During this gap period, your taxable income is often lower, creating a perfect window to convert at low rates before those mandatory withdrawals start pushing your income higher. One word of caution, though. Watch out for Medicare's IRMAA surcharges. That's the income-related monthly adjustment amount. Basically, a penalty that kicks in if your income gets too high. A large conversion in 1 year could trigger higher Medicare premiums 2 years later. The solution: spread your conversions across multiple years. Of course, and always, it's wise to get some advice from your tax expert and wealth manager. Okay, then. Well, now let's tackle something that is a little surprising and disappointing. Social Security benefits can be taxable. I know. You've been paying into this system your whole working life, and now they want to tax the benefits too. Well, unfortunately, yes, the IRS uses something called provisional income to determine how much of your Social Security gets taxed. They add up your adjusted gross income, half of your Social Security benefits, and any tax-exempt interest. If you're single and this number hits $25,000, or you're married and it hits $32,000, up to 50% of your benefits become taxable. Push it to $34,000 for singles or $44,000 for couples, and now 85% of your benefits are fair game for taxes. But here's where being tax-savvy really pays off. Remember those Roth withdrawals I mentioned earlier? They don't count toward your provisional income, so you can pull money from your Roth IRA without making more of your Social Security taxable. It's like having a secret stash that the IRS can't touch. Another strategy: if you have other income sources, consider delaying Social Security until age 67 or even 70. This gives you more years to do Roth conversions and strategic withdrawals without affecting your Social Security tax situation. For those of you with pensions, and yes, they're generally fully taxable, blending your income sources becomes crucial. Instead of taking everything from your pension or traditional IRA, mix in some Roth withdrawals or after-tax brokerage account money to keep your overall taxable income lower. So, what's your action plan for 2025? First, leverage these lower tax rates while you can, with potential increases looming in 2026. This year is your opportunity to withdraw or convert at bargain rates. Second, get strategic with Roth conversions. Convert amounts that fill your current bracket without spilling into higher ones, and spread these conversions across multiple years to avoid Medicare surcharges. Third, blend your income sources. Mix taxable, tax-deferred, and tax-free withdrawals to control your taxable income and avoid triggering higher taxes on Social Security. Fourth, don't forget about state taxes. If you're considering a move to a different state, research retirement-friendly states that could significantly impact your net income. And finally, and this is crucial, plan early in the year. Tax planning works best when it's proactive, not a rushed, last-minute decision. And remember, being a tax-savvy retiree isn't just about saving money. It's about gaining peace of mind, knowing that your retirement income strategy is working as hard as you did to earn it.